All right, let's do it. Let's do it. So go ahead and introduce yourself, brother. Go ahead and get that out the way, and I'll do mine as well. Just so the people tuning in that may or may not know us, they know exactly where we're coming from and, a little bit about you, brother.
All right, so listen, man, I am Dub Washington. I always tell you to say your grace right because I ensure that everybody eats. And on top of that, another thing that I do is I make the banks compete to lend you money. So I have a heavy background with going through, being in a space just like each and every one of you on this call. So I know what it feels like to be in this industry and just be shotgunning your credit. And if you're not familiar with the verb shotgun, it's like whenever you go and apply for multiple products and you just go and apply for a whole bunch of banks at one time, right? But those were things that were applicable a few years ago, right? So now trying to do things like that, it's more strategic than anything. So what I'm going to teach you tonight is how to audit the banks, how to make the banks compete to lend you money, and my personal blueprint on how I have funded myself over $2 million since I started in business in 2021. So like I always say, man, say your grace and let's eat.
100%. That was a great intro, bro. Yeah, I got to follow up with that. So, like Dub said, man, we come from humble beginnings. Been in a lot of similar groups, RPX, the other ones you name, different things like that. And my aspect's a little bit different, man. So I funded myself and honestly didn't really know where I wanted to go with credit or entrepreneurship, right? One of those things where you're trying to find yourself, but you don't know exactly what lane you're going to. You just learn about credit and you're like, damn, where this been around my whole time? So I went through manufacturer spending, learning that from Dub, getting different information and getting quick little wins. But we all go through that we all have that phase where it's like traveling for free is cool. Getting credit card points and all that stuff is cool. But we get into business to make money. You know what I mean? Like eventually, like the MS is cool, but we want to make some type of money. We want to have revenue coming in. And that's where I kind of got into credit repair first. And now really just hyper focusing on funding. So what I do from a funding standpoint, well, let me back up. So me personally, I don't have over $200,000 in funding, different things like that. Right now, I have about $170,000. My aspect on is a little bit different. I only want to actually apply and get what I can leverage, right? Because I've seen so many nightmare stories of people being over leveraged, right? People want $100,000, $200,000 of funding, but they never had that amount of money in their hand at once, and they don't have a proven game plan when it comes to that money. And that's a recipe for disaster that I've seen. That's not everybody, but we see it time and time again. So I usually get funding as needed, make a return on my investment with that. One, to actually keep myself and pace myself and be responsible. But also, two, I don't just waste 0% interest time frames, right? That's very, very important. That's something we're going to talk about today. So currently, I'm the CEO and owner of Waiters Capital, a business funding company. We specialize not only just credit card stacking, so your Chase, Wells Fargo's, different things like that, but we're really, really big in the alternative lending space, right? Which is private money. So a lot of our lenders are on Wall Street and it's revenue-based lending. SBAs, equipment financing, invoice factoring for trucking, different things like that, merchant cash advances, true business lines of credit. So that's where I come from, and that's what me and my team are doing every day. And both of us put together, this is going to be one of the best calls you guys will ever be a part of. And like I said, we need that chat to go crazy, man. We need that chat to go crazy. Look, my guy look amazing with the background. I got the tie on, man, so we ready to rock and roll, bro.
Let's get it. Let's get it. So first off, we wanted to basically bring everybody back to the beginning. And whenever I say the beginning, it's like the intro to funding, because a lot of y'all will see different things online and you are not qualified to get certain types of lending. So you may see things online and you'll see a lot of people may come up and they may promote no PG funding, right? And I speak on that a lot. And I tell people, whenever you're trying to go and get no PG funding, if you don't make at least $4 million a year, disqualify yourself. A lot of y'all are chasing for things that you are not qualified for. So just understanding the intro to funding, and that's going to take us along, kind of like where we start at tonight with everything and just kind of kicking it off. So whenever I say intro to funding, there is different types of funding, right? It's not just credit cards, even though that's my favorite. I ain't even going to sit here and lie to y'all and act like credit card stacking is not my favorite, solely because no other product is going to give you 0% APR funding. And then on top of them giving you 0% APR funding, you are getting it for an extended amount of time. You are getting it for up to 18 months, up to 24 months. And then with creative methods that me and Sted know is like we can extend it possibly even 2 or 3 years. So whenever you are going for funding, the first thing that you must do is understand what type of funding that you're going for. And this could be credit cards. This could be personal lines of credit. This could be personal loans, business lines of credit, SBA, like all these things right here. So that's where we're going to start off at tonight.
100%. So to go ahead and really add on to what he's saying, if you are a funder, or you're somebody looking to fund yourself, a couple questions you want to ask yourself, and we do this with our client intakes as well. You want to understand your situation, what can service you bet, and realistically how much capital you need. So what do I mean? If you're a startup and you know you have no revenue, then you know you're going to be typically limited to 0% interest business credit cards. Even if you have bad credit, but you have a spouse, you have a credit partner, somebody that has good credit, you can leverage their good credit to still get access to business credit cards when it comes to 0%. Rolling a little bit back, if you're on the personal side, right, you want to look at it and say, what's my credit score? How much income am I bringing in that I can actually show to lenders? And then what am I using this capital for, and how much do I ideally need? One thing that helps a lot of people jump over and skip to be able to get decent to nice limits when it comes to funding is if you have a good job, right? If you can show, like, lenders want to look at two things. They want to look at your credit report to see like how you are as a borrower. Are you good at repaying things back? Do you have a thin credit profile? If you have a thin credit profile, the only thing that can save you, that can prevent you from having to build as much, is if you have a good job, right? If you have a good job and you can show income and you're making $6,000, $7,000, $8,000, $9,000, $10,000 a month as an engineer or whatever your profession is, you can still get access to capital because lenders will look at your actual income and say, okay, this person is bringing in X amount of their job. We can take a risk on lending them something because they have some way to pay us back when it comes to it. So always look at your credit score, your income, because a lot of people forget income. Everybody want no docs, but if you have docs, you're already ahead of 50% of people. You know what I mean? And then look at what kind of capital you need, what do you need it for, and then going from there.
I love it. I love the fact that you hit on the income aspect of it, because I always tell people whenever they come through me to get funding, right, or my funding company to get access to capital, I'm like, if you have a W-2 job with consistent payments, banks love to see that, right? Because to be honest with you, right, instead you let me know from your experience as well. If you have somebody that's coming in with a job that they've had for 2 or 3 years, they got the taxes, they got different, income verification documents, and you are making $100,000 to $150,000 a year, and you have a steady job, you are more lendable than that business owner who just exceeded 300,000 or 400,000 the previous year. Because as an entrepreneur, it's ebbs and flows. They have what you call seasonality, right?
Yeah.
And depending on your NAICS code, you have different seasonality that the banks will categorize you by, right? Typically with consulting businesses, etc., right? You're going to see towards the latter end of the year, you're going to see typically you have a little bit of a dip in your income, and banks understand this. And then how they get this information is based on previous business owners and entrepreneurs that they have lended to.
100%. I 100% agree. Like he says, like, to just follow up exactly what he said, he hit it right on the nail. There's no way to say it even more perfect. But like you said, when you have a job, you have consistent income. If you've been there 2 or 3, let me back it up. What lenders want to see is consistency, reliability, right? And safeness, like low risk. So if you have a job and you've been there 2 or 3 years and you consistently been making 100K, 150K, even 80, 70K are good amounts to make on a salary, right? A lender will take a chance on you and lend you that money. Like you said, first is an entrepreneur that may have a 50K month one month and a 5K month the other month. Why? Because they can't judge which is which. Like, imagine if we're lending out money, we want to lend it out to the person that could consistently show us they're making 5, 7K a month, right? If they can show us, okay, every month I'm at minimum bringing in 5 to 7K because of my job, maybe some extra commissions, I'm going to be 10 times more comfortable lending to that person than the person that's a quote unquote entrepreneur, but have a 5K month and then a 50K month and then a 10K month and then a 5K month again. Why? Even though they're technically bringing in more revenue at that point, it's inconsistent. How can I judge as a lender how much I should lend you, right? Like, that's a big gap. 5K and 50K is a big gap. Where do I fall in the middle to understand your cash flow and your problem and needs? And also looking at your credit to say, okay, we feel comfortable at this, okay, because, you know what I'm saying, we realistically see that you have the income to pay us back if anything such go wrong. You feeling me, Doug?
Absolutely. I love it. And that's kind of make us segue into the next point, which is once you have gone through the income verification, you got these taxes, you got W-2 income, whatever the case is. Now we want to actually kind of take a step back and go over your personal FICO scores, right? So this is going to segue us into the next point is you understanding the different FICO versions. I talk about this a lot, is that most people will go and then they'll say, hey, I have a 750 on Experian, a 750 on TransUnion, or a 750 on Equifax, but that is not what the banks are pulling. They don't care about your overall Equifax score because depending on the product that you are going for, that's going to depict the type of FICO that they're going to use for that particular lending. So credit cards, right, which that's going to be by far the easiest products to get approved for with little to no documentation as of the time of this recording, but you can go and get access to $30,000-$40,000 without showing income, but your FICO 8 and your FICO 3 needs to be somewhat strong. And how do you build out the different FICO versions? Like if you're going for credit cards, you need to build out your revolving lines. You need to be able to have at least 2 or 3 products with it, $1,000 limit, a $10,000 limit, because you're building out a FICO that they lend off of. Similar to, and I always give this analogy to my sports heads in here, is like, you got to know where you stand at in the bank's eyes. If you throw Shaq the ball at the 3-point line, everybody going to back up and try to get ready for the rebound. But if you give it to Steph Curry, you need at least 2 or 3 people going out to close on him. You see what I'm saying? So it's no different with the banking sector.
100%. We got to stop walking into the bank blind, right? I see a lot of people, especially in our community, or people that don't have this financial literacy, they're praying and hoping and not educating themselves before walking into the bank, thinking that they can just become good friends with the banker and they're going to be the one to be able to get them $100,000. And it realistically doesn't work like that. You need to do your research before walking into the bank, right? Understanding, like my guy Dub said, where you're at, right, with your credit and everything that you have, but also understanding that banking's lending procedures, their requirements, their minimum requirements, and trying to meet those. A lot of people don't understand. Banks tell us what they look for. Like, a lot of people really don't understand that. Like, they tell us what they look for, right? We can find out who they pull from, right? They let us know what products are typically stated or not stated, and they tell us typically what's the minimum credit score, right? But it's up to us to meet those requirements and even exceed them if we want to have the valuable results that we're looking for, right? So when you take a step back before walking in the bank, make sure you evaluate yourself, educate yourself, right? And me and him are both in the funding industry, and I wholeheartedly can tell you, I tell my mentees all the time, I'm pretty sure he tells his mentees, once you get this information, you're going to be more educated than, I would say, 85% of bankers. Just be honest with you. You're going to be more educated when it comes to credit, funding, finances than 85% of bankers that actually work at an actual bank. Just being 100% honest with you. But what you want to do is make sure you prep yourself before going into the bank so that you can have favorable results when it comes down to it.
1,000%, bro. 1,000%. Another thing I want to kind of segue into is auditing the bank. Because yes, you can know what the requirements are, what the lending rules, you can know all of these things pertaining to a particular credit union, bank, whatever the case is, right? But I always ask people, when was the last time that you audited the bank, right? And what do I mean by that? A lot of you are going to apply for products that bank don't specialize in. And just because they offer it, that don't necessarily mean it's their specialty. I see a lot of people go to a Navy Federal and they try to go for a business credit card. Yes, they offer the business credit cards, but that's not their specialty lending. Navy Federal is more so known as a personal bank more so than a business bank. Because whenever we get into the business funding aspect or business capital, you want to make sure that you are able to leverage a 0% APR. You know what I'm saying? So you have to be very, very on point whenever you audit the bank. So a few questions that you want to know, like, depending on my NAICS code, how does this particular institution view that? Because like Sted said when we first came on, is like, we remember whenever consulting was a hot topic. We remember whenever that NAICS code was it. But fast forward 4 years later, majority of those cards that's been defaulted on the business side, guess what NAICS code was attached to it? 41612. So you have to know this and know where you stand at. And I know a lot of people may be in the chat and say, okay, like, well, I have a consulting business. What should I do? Should I change it? Well, if you established it before 2023, you should be good to go, because guess what? You now can provide taxes. You now can provide documents. And if you have been in business since 2021, 2022, and the bank asks you to provide documents, would you give yourself funding?
100%. And that's one thing that we're going to talk about later, because we got to stop just giving the bag and not giving the real, right? The point of business is to make money. That's the whole point of getting into business. Every entrepreneur, everybody on here, you want to find out that just be flat out simple. You want to find out how to get money to make money off of that money, right? That's the main goal. That's the main priority of everybody on this call. It's the reason why you guys are here, right? So with that being said, if you had access to money for 2 or 3 years, there's no way you shouldn't be generating revenue. There's no way with the information you have here, because you have your everyday Joe Blows, your average Joe Blows that my company deals with that never had a mentor, never knew anything about funding, never knew anything about leveraging the bank's money. They started from scratch with their own dime, worked their ass off, took them 10 years to start making $20K consistently, but they still have that end goal of making money. You guys have the experience to hack the exposure to eliminate that learning curve, right? You got to understand the past generation. A lot of people that are not in this credit financial literacy space, they're just taking all the money in their savings and just saying, fuck it. It's either we get it or we don't. And they just rocking out with it. But you guys have the access to the information to be able to go get funding, right? Save your $50,000, get funding, and invest that into something that can make you money right away and eliminate that learning curve. So understand the opportunity that we have with this information and the access to capital that we have above us, and never take it for granted. And I'm pretty sure anybody that has not so great credit can attest, right? You know how it is to have bad credit and the banks deny you. You like, damn, I wish I had that 700. I wish I can get that 20K, 0% interest business credit card. It will be over. So for you that are on this call that have good credit, value what you have, because there's a lot of people that wish they could be in your position as well.
1,000%, bro. I love that, and you hit on it. So I'm gonna segue back to just basically putting your, and I always say, $1 million profile or your $1 million portfolio together. And I'm speaking from experience, because this is something that I've done. Whenever I first got in the funding space, I ran the plays, right? I applied for things out of order. I applied for products that, and Sted said it earlier, is like, you never want to let a 0% APR phase go to waste. And I've done that, because I went out and I was like, oh, I see Citizens is giving out 50K. I see, First Citizens is giving out a bag, etc. And then I'll go and run the play with no particular plan. So whenever we speak, we are speaking from experience. I've went out and I did that. Shotgun my profile, done different things. So what I want to kind of revert back to is the actual FICO versions and structuring your $1 million profile. You have to understand there's a difference between a FICO and a Vantage score. A lot of y'all are pulling up Credit Karma and you'll see that you got an 820, 830, but that's not what the banks are lending on. Remember, I told you there's 16 different FICOs, and that's what the banks lend off of. Banks will not lend to you on a Vantage basis. So you got to make sure that you understand the difference between those two and building them out. You don't want to be too heavily weighted with just credit cards, because whenever you graduate and you went to multiple institutions and you have, credit stacked and got access to, let's just say, $500,000, which is very easy to do. Now you, at some point in time, you're going to graduate to a different form of lending, and it could be a loan. It could be a line of credit. And if you don't have the data points that you have built out already for the proper comparables, then the banks are not going to look at you serious, and they're not going to lend a lot of funding to you.
100%. So to break that down in dummies terms, how should somebody structure their credit? Like, as far as payment history, breaking that down, and I'll give my two cents on that as well. From payment history, negatives, accounts, utilization. Give them your definition of that, and I'll give them my definition of that as well. So
I love it.
From two different mouths.
Bet. So just a general structure that you should have is 100% payment history. And if you don't have 100% payment history, then you at least should have no late payments over the past 2 years. Because I know a lot of people say, well, you got to have 100%. Well, that's not always the case. You can have something you can have a late payment on your profile that's older than 2 years, and it's not going to hold that much weight, right? So you can have one late payment on there that's older than 2 years, and you still can get access to capital. But it is very much ideal to have 100% payment history, removing all late payments, etc. But most importantly, in my opinion, even though it's not weighted as high as your payment history, but it's pretty much the mixture of accounts and utilization. So whenever I say mixture of accounts, you don't want to have just credit cards because your FICO 8 is going to be up here. But then whenever you go and apply for a business line of credit and they may pull your FICO 3 or your FICO 5, right? Then your FICO 5 is going to be here. You have no history of borrowing $50,000, $75,000 and making installment payments. So you have to make sure that you are diversing across your portfolio or your profile to make sure that you get access to large amounts of capital.
100%. You still should be good when it comes down to it, as long as there's no other negatives on that, right? Understand that payment history is one of the strongest and biggest factors that underwriters look at when making a decision on lending, because they want to see your capability to borrow and pay back, right? So that's one thing you want to have. When it comes down to utilization, I'm a little bit different than most people. So having a funding company, I know typically best practice is 10% or lower, but realistically, that's not realistic for the public, right? Most people are not able at that time to pay down the utilization at 10%, right? So realistically, even with my funding company, I tell people if you have anything 40 to 35% and under, we're still good to go as long as all the data points actually match up as well, right? Obviously, no negatives when it comes to traditional lending, no doc funding. That's what we're talking about right now, right? So no negatives. You have those, you want to get those fixed. I do have data points to talk on the other side of getting people funded with one paid charge off, right? For like $500, a Capital One account. Not too many, and it wasn't a lot of funding, but it still happened. But that person had other accounts to show that that was a mistake. They corrected it and had other high limit personal credit cards to justify being able to get funding on the business credit side, right? Going to the total amount of accounts, like Doug talked about as well, whatever product you're looking for in the marketplace, you want to make sure you have existing products that underwriters can base that lending off of, right? That's exactly what comparables are, right? So people get a lot of this stuff misconstrued. If you're looking for, you obviously want a mixed profile like Dub talked about, but let's say you're specifically set on, let's say, getting business credit cards, right? You need to make sure you have comparables on the personal side to justify getting a high limit business credit card. The same thing when it comes to the auto loan. For anybody in here that drives cars, I got a McLaren, I got a Corvette. I wasn't able to get those things until I had comparables on the personal side that justified showing that I'm capable of borrowing that amount and paying it back, right? So whatever you're looking for in the marketplace, you want to make sure that your personal credit shows that before going to apply for more, right? So that's one thing I look at there. I know me and him probably can go back and forth with inquiries. A lot of you guys probably already know that you can remove inquiries. Inquiries are not the worst thing, right? There are some lenders that are very inquiry sensitive, and that's where you educate yourself in knowing who to apply for first, but it's not the end all be all. I see too many people cry over inquiries thinking that that's the non-factor that's going to be the main decision if they're approved or denied. That's not really the case, right? There's a lot of banks, especially on the business side, that are not as inquiry sensitive, and a lot of us, we got the game on how to remove inquiries, so that shouldn't be a big deal anyway.
Yes, sir. I love it, bro. And I kind of like the fact that you hit on like a more diverse portfolio over just going for one individual product. And before you go and add these credit builder accounts, I'm going to let you know that banks will judge you off of that. Like before you go and add, and I'm against them. I'm just going to be, I don't know how Sted feel about it, but I know a lot of people will tell you, hey, go and add kickoff, go and add self. Go and add these credit builder accounts, but you have to think in terms of sculpting your masterpiece, right? Like credit is nothing more than, an art piece. Like you have to sculpt everything. So whenever you get 2 years down the line and a bank looks at or underwriter looks at your profile and they see that you have a kickoff, that insinuates that you are repairing or you're building. What are you building from? So before you go and do this, I recommend that you go out and you build with institutions before adding that kickoff, adding that self, adding all of these credit builder accounts. Go the secure card route. Because let me tell you, and I learned this from my guy right here, is like, what does a secure card tell the underwriters? That you have access to capital. And that's the number. And whenever you said that, Jim, bro, on the podcast, I was like, bro, like how you broke it down. I'm like, damn, like I never looked at it that way. And certain times, like we learn a lot from each other. And it's like, whenever you hear different people's perspective on a specific topic, you're able to sculpt your own, right? So I'll tell people all the time, is like, listen, don't go and add these accounts because when the underwriters see it, they're going to judge you off of that. You see what I'm saying? So that's very, very important. Along the way, along with the profile and everything that you add, be mindful of what you add to your profile.
100%. So I 100% agree with my brother right there. So for you guys that don't know essentially what secure cards or secure products are, it's basically you putting up your capital, building a relationship with a lender, and basically them reporting on your behalf to basically help build your credit, right? So it's a more premium credit building type of account. It's still secured, but you're putting your capital up. That's what's securing it, right? To be able to justify showing your credit report certain amounts. So let me kind of break it down, right? It goes back to what we talked about in the beginning. A lot of people are so stuck on the credit aspect, right? And the credit aspect is very, very important, but understand that banks look at income as well. And that's why I say if you have clients, if you're a funder, or if you're trying to get funding yourself, you want to paint the full picture of how your credit looks, but also how your income looks. Because if your credit's not getting the job done, some underwriters, some lenders may pull your card and say, okay, well, let's see what your revenue's looking like, right? And based on that, they're able to lend off of you as well. One way to be able to show liquidity is a secure product, right? When you get a secure credit card, you're putting your money up, right? Your money as collateral to be able to build your credit. So when an underwriter pulls your report and sees that a secure credit card, they see liquidity because they see that you took your $10,000 and put that towards building your credit and building their relationship. Most people don't even have $10,000 in their bank account, and you're putting that on a credit card, right? The same thing when it comes to secured loans with Navy Fed. That's the most famous one, but there are other credit unions like DCU, Air Force Credit Union, ones you don't have to be in the military that you can be a part of that offer secured loan products as well. If you go and take $20,000, $30,000, $40,000 and put that secured loan on your actual credit report, you're now building comparables from day one. And when an underwriter sees that, the perspective of that is, okay, this person is in the credit building phase, but we can see that they're liquid, right? We can see that they're liquid and they have some type of income or some type of reserves to where they can handle lending and capable of handling lending. So when I talk about secure products, a lot of them get a bad name, but people just don't understand what they're looking at compared to your kickoffs, your sales, right? They probably help your credit a little bit. It makes you feel good, makes you feel like you're doing something, but in reality, you're not going to get much from a lender when you have those accounts on there. I can't tell you how many applications we get for people that have 700, so they apply with my company, Waiters Capital, and then we look at their credit profile, and it's kickoff, self, a $500 Capital One card, and 5 authorized users, right? And it's like, bro, we really can't do that. And they want a minimum $100,000 in funding. It doesn't work like that, right? So that's where the education part comes in and why you guys had the luxury of being able to talk to us. So I'm really, really pro secure products to help build out comparables. It helps you skip the line really fast. When it comes to credit building products, I'm more so like Tomo Boost and Credit Strong, right? Dub may be a little bit different, but I like those primaries because they're a little bit more premium. And with Tomo Boost, the actual credit builder one, there's 2 variations of it. They actually have it to where you can pay to have a $35,000 primary reporting on your actual credit report as well. So that's one thing I like. But how you feel about that, Dub?
No, that's clutch, bro. And certain ones are going to hold more weight. But you see, whenever we're talking to the audience, most people will think like all credit builders are essentially the same, and that's not the case. Because like you said, that Tomo Boost, primaries like that. And I'm glad you said primaries, because a lot of y'all are going out and being added as an authorized user. And I'm going to be truthful to you, especially with talking with my underwriters and lenders, etc., is whenever you come in and you are added as an authorized user on someone's card, they're looking at it, but then they're wiping it off. And then they're looking at the primary account balances that you carry, because you can manipulate it. You can have 100% primary utilization, and then someone go and actually add you on their card as an authorized user, and then you can have your utilization shot back down to 10, 20%. But whenever you are going for real capital, business credit cards, personal credit cards, etc., the underwriter is paying more attention to those primary accounts versus those authorized users. So do not go and add, too many authorized users on the profile. Now, if you want to manipulate age, that's when authorized users come into play yet. But as far as trying to lower your utilization and do things like that, we know that the banks are on to us, right? Like, as soon as we get a hold to some good information, or we try to, be able to manipulate something, they're going to move the goalpost back. And that's what happens every time, literally with us. And let's just speak real here, right? Like, we really got to understand that as a whole is banks will tend to do that. So you have to be ahead of the curve whenever you're understanding this and say, okay, even if I have to take a $500 primary and build over time, because if you know how to leverage with manufacturer spending, liquidating the credit cards, etc., it's okay to start with that because this is your account. And as you build out over time, you're able to literally run these limits up. And that's how I was able to run mine up at first. Like, and I know manufacturer spending get like a, a frowned upon look whenever you really don't understand it. But you're maximizing your credit limit increases whenever you do this. It's not to just go and get the free trips and the free design, all the things that people push it as. Like, if you got a strategy behind it, it's no amount that the banks won't lend to you. And that's how you really maximize the amount of credit that you get outside of, adding a credit boost. I mean, these Tomo boosts and these credit builder accounts, which those two are good. You know what I'm saying? I was speaking in terms of like the kickoffs and things like that most people don't understand. Like, oh, bro, I can go and add this and go and get it back. That's not the case.
And one thing before we switch over to business credit, bro, I know we talked about it a long time ago, but I feel like that's a real experience that you should let the people know, man. Like we talked about it earlier. You said shotgunning your credit and running up $100,000 in funding, right, on the personal side, and now being overexposed to some lenders. Let's take it back. I remember a while ago you was telling me that you regret doing that because you didn't even tap into Chase. You know what I'm saying? You didn't even tap into Chase. So that's another thing that people don't look at when they're building their personal credit or they're going out and getting the bag on the personal side. It's Chase 524 rule. My guy went and got over $100,000 in funding on the personal side and completely forgot about one of the biggest banks with the best perks out there, right? So you can talk a little bit about that before we slide over to business credit, man?
1,000%. So with that, I got access to information. I fixed my credit, and I was just like majority of y'all in the chat. I was like, bro, okay, I got a 750 plus credit score. I'm just going to go and just get access to capital. That was a mistake, but not a full mistake, because if I knew the correct order to go and apply, that's how I've been able to leverage it even more. But whenever you get access to this information and you get excited, sometimes you got to strategize. You have to have a sequence with this type of capital. Like, listen, it's very important, right? It's one thing to get access to the capital, but whenever you do it in a sequence, you, one, get more, and two, you understand it more. So I went out and I was shotgun. I was open up the 4 or 5 tabs, and then I was like, okay, all of these banks pull from one bureau. I'm going to just blitz them this way. I'm going to apply for each one, and I'm trying to hit submit simultaneously around the way. Well, you just went and got 4 or 5 inquiries on your profile, and yes, you can remove them, but the amount of new accounts that just hits your profile, now you have to sit in a garden. So you got to know that you need to hit the Citibanks, the Chases, Barclays. Particular institutions like this, they are more inquiry sensitive and new account sensitive than the American Express, than other institutions as well. So that was a major mistake that I did along my journey, was getting access to the credit way too fast and not having a structure. That is very, very true, bro.
100%. So I'm glad we had to get the people that, man. So now we're going to move over to business credit, bro. And I'll let you lead the first topic that we got here, just understanding true business credit.
I love it, bro. This is very important. And I think most people don't understand this. True business credit. You don't build true business credit by going to get Quill, Uline, Granger. I'm just going to be honest with y'all. Like, you don't build true business credit that way, because that is going to build a paydex score. Banks don't lend off of a paydex. Yes, you can go and get a few, you may can go and get a car, under the business name, but you can also do that with Bank of America as well without any paydex if you build out the solid comparables. So true business credit, what we're going to be talking about, how to structure that. And I don't want to go too far ahead, but how you build true business credit is by having business comparables. It's no different on the personal side than it is on the business side, and vice versa. You don't want to go and add a whole bunch of credit cards, right? You don't want to go and add the Sam's Club card and the Home Depot card. All of these cards where you can only spend money at these particular institutions or particular stores. You don't want to add too much of them. You want to get comparables added to your profile. So comparables that could be added to your profile are Bank of America, Wells Fargo, a lot of the Eline financial institutions, Truist, PNC. These institutions are how you're going to build true business credit. Why? Because they're going to report your business utilization to the business credit bureaus. You know what I'm saying? So you have to be very, very aware of that along the way. Is don't get so caught up into going to Quill, Uline, Granger and saying, hey, I have an 80 or 90 paydex score. I can go and get access to no PG funding. That's not how it operates.
100%. And I'm going to touch on that as well. We did, but I'm going to always beat this into y'all head because I feel like this is something in the market that takes advantage of a lot of people. People get this ideology that you can build business credit no matter how your personal credit is. You have no proof of concept. You have no revenue in the business. And you think because you have a 90 paydex score that a bank is going to trust you with 10,000. I'll say low, very low, even 10,000. And you're going to be able to get the bag. It does not work like that. Banks are not stupid. They understand. And one thing that we can talk about, I know we both can attest to this, back in the day, Sam's Club actually had an actual real business credit card that was technically EIN, no PG, right? Technically,
Yes.
right?
Mm-hmm.
Dub, do they offer that anymore?
No, sir. No, sir. Like it was a time where and that is very true. Like you could go, that was everybody's first no PG business credit card. I went and I ran the play, right? I went and added Quill, Uline, Granger, right? Added Nav Boost, all these different things. And I went and I was like, oh, I really got this without putting my social security number on the actual application. So they gave me like a $12,000 limit. But the thing was, I was like, okay, what other banks can I go to do this? And then I'm looking and I'm like, bro, like you're not even gonna get that. And it probably was a reason why they got rid of it due to default rates. Like y'all, once again, I'm bringing it back to everybody's that whenever we get access to information, the people that's in the higher power, they're going to move the goalposts. So you have to consistently stay in the know. So to answer your question, bro, like that Sam's card gone, bro. Like that no PG play is done.
It's 100% done, and that's what I like to bring. So it just goes back to the purpose of business is to make money. You figure out how to get money, but it's making money on top of that. So like Dub was talking about, building your business credit is good, even on the business credit utilization. So I know a lot of people in here probably can relate, where your personal credit profile is phenomenal, right? But your business credit, like structure credit profile, is just high utilization, right? You probably don't have any missed payments or anything like that, but you have crazy high utilization. You may be invested into the business to run and play, but you may be looking for more funding. I know a lot of you probably fall into that category as well. One bank you do not want to waste your time going to. And if you have a funding company, you should be doing your due diligence of asking your clients during the intake, right? Do you have any existing business credit cards? If they say yes, who are they with? What are the real deal utilizations on those business credit cards? One, if they have high utilization on existing business credit cards, you cannot double back with those banks, right? So let me give you guys a real life example. If somebody has a Chase business credit card, the in cash, right? You cannot double back with Chase if that person has high utilization on that business credit card. You're going to get declined. Don't even waste time doing that, right? Another bank that I'm going to put y'all on game with as well that checks business credit consistently is PNC. PNC is known if you have high utilization on the business credit side, they will auto decline you right off the bat because of that, right? So that's one main bank you want to make sure that before you send yourself there, before you send your client there, you have low utilization on the business side. One workaround, I'm going to give you guys some game, is if you have a different LLC, remember that business credit is not attached to it. You can go run through that LLC and get some type of funding. But if you have an existing or your current LLC or business, whatever it may be, right? If it has high utilization on the business side, do not waste your time going to PNC. It's going to be an auto decline. Can you agree with that, Dub?
100%. And also, but we get into the steak and potatoes of everything, because you got to understand, most of y'all, whenever you pull in your business credit reports, you're going to Nav Boost, right? I mean, or you're going to Nav to pull your business credit report. And yes, they will give you a score, but you need actually in-depth information on your business credit report. So going to Nav is the equivalent of going to, let's just say, like a Credit Karma, right? Like they're going to tell you what's on there. They'll tell you, the utilization of the card, etc. But you don't know what's reporting to the bureaus. Certain credit cards won't report your utilization to the business bureaus. American Express, for example, they're not going to report that utilization. They only report negative activity. So this would be too much for this masterclass, but you have to get a Rolodex of banks that hey, I know that they're going to report my balance. Wells Fargo will report that balance. Bank of America will report that balance. I'm getting a mixed bag with seeing that Chase may report the balance. I'm carrying business credit balances on Chase. I haven't seen it pop up on mine, but you have to know which business credit cards are going to report to your which business credit cards are going to report the utilization to your business credit profile. And then from there, you're able to get more in-depth information. And if you don't know how to pull that, you go to smallbusiness.experian. You want to go and pull your Experian business credit report, not NAV, not Duns and Bradstreet, not any of those, because they're not going to go in depth on the days beyond trend, the actual recent high of the credit cards, all of that. So make sure you pay attention to that along the way. Like, bro, we get into it now. We cooking up.
100%, 100%. And just to add to that, man, like, if you are somebody out there that already have a cash flowing business, you don't have to go through all these hurdles, right? Understand that's the luxury of making money in business, right? You can show the bank statements, you can show the revenue, you can show the tax returns, and they can care less. Because if the business is making money and you have a proof of concept in your business, you're going to get some type of lending, right? So we're talking from both aspects. If you're being strategic, trying to get that no-doc funding when you can slide through without documentation, you got to be more on that Rolodex of understanding credit, optimizing it, building comparables on the personal and business side. But if you are a business owner that can show revenue, right, that can show income, that can show, like I said, that you have healthy bank accounts, right, day-to-day, daily balances, no negative days, different things like that, you can go and get capital now without having to build out all these different things. You still got to have the foundation. Don't get me wrong. You can't just go in there with nothing and expect everything. But if you have at least a foundation and you can show that you're making money in this business, you're going to get money. You're going to get money, right? Understand that in every business out there, that's why it's no excuse. There's somebody that's a multimillionaire in every industry, right? People talk crap about trucking. There are trucking companies that are billion dollar companies, right? People talk crap about consulting, but there are real consulting firms that are billion-dollar firms. You know what I mean? So there's always opportunity to make money in every industry. It's just about what work, what proof of concept, what guidance, and what you're looking to put into to be able to receive that back, right? So like we talked about, business credit is something that you definitely want to tap into. But if you have the revenue to show, you're gonna skip the line with a lot of these guys.
Yeah, 1,000%. Another thing that I want to hit on while we're talking about like the business credit aspect of things is that you have to be super strategic in the products that you apply for, right? I always recommend, if you have a personal relationship with that bank, then you're going to get a higher approval rate based on them understanding you as a borrower, right? What is your borrower behavior? You know what I'm saying? And you can start on the personal side, leveraging them personal credit cards. And whether you, and we're going to be real tonight, whether you manufacture spending, whether you actually, investing it, getting a return on it, etc. If a bank offers personal products and they offer business products, you now have the availability to bypass certain restrictions because they already understand you. That's why I talk about in my 3-5-90 sequence, whenever you're building out 3 to 5 banks every 90 days per bureau, is to go to banks that offer both forms of products. So if you're starting from scratch, you're probably in the best position that you could ever be in because you're able to sculpt this profile from the beginning. I wish I had this masterclass whenever I first started my journey to have some sort of roadmap to get where I want to go in a strategic manner. You know what I'm saying? Because I went and got access to capital. The first, year or so, I had eclipsed over $1 million, right, in funding. But then I had to literally sit down in a garden, as they say. I had to sit back. I couldn't apply for nothing because I had about 30-something accounts, right? I literally went in a year time frame and went and got 30 different products. Now the banks are looking at me as like, one, we see that you have access to capital, but even on top of that, you got a whole bunch of new accounts. And they house this information. We're gonna dive a lot deeper into it here shortly, but the underwriter, a lot of y'all are going to the same exact bank and don't realize it. Just because you see Renaissance Bank, just because you see Ameris Bank, just because you see Coosa Valley Credit Union or that local credit union that's near you, that is a different credit union or possibly even a different bank. But if they're underwritten by the same underwriter, the underwriters are going to have an exposure too. So what is the underwriter exposure? Once you go and get 2 or 3 credit cards with them, you have to be very mindful of that along the way.
100%, because the same files are showing up on their desk and they're looking to see if you have a relationship with that bank. What are your deposits looking like? And it's like, damn, we just gave this person 2 or 3 credit cards and we don't see no income coming through the bank account. We don't see no revenue coming through the bank, no deposits. You know what I'm saying? But they want more funding. But they're saying they're making this. So we got to start having those realistic conversations with ourselves and just understand that behind those banks, there's a human that has common sense, that has a credit box, that has protocol, that's looking at your file, that's looking to see, like, does this really make sense? Is this person really making X amount? If we already gave them funding, their utilization is mediocre, not excessive high, but mediocre. And when we look at their account, there's no deposits coming through the account, right? So we got to understand that. And that's why I said that's the goal of actually getting into funding and getting funding is making money off of it. One thing I want to talk about too, my guy Rico actually said something really, really good in the chat. He said, what if you have collateral assets when it comes to lending, when it comes to banking? I'm going to go ahead and answer that because that's one thing that we carry on as well, right? So when it comes to lending, especially on the business side, banks want something, right? They want credit, they want income, and if you have collateral, that's another positive. That's another positive because that's something they can put a lien against to secure and make them feel more comfortable in lending you money, right? That's just like to just break it down to everyday Joes, right? When you go to a pawn shop and you're looking for money, right? They want something in return to make sure you're going to pay them back. That's essentially how asset-based, collateral-based lending is when it comes to lending institutions as well. If you have an asset that's actually worth something, whether it's a piece of real estate, it's an equipment, something actually worth value, they will lend against that to you, and it makes more sense. So even if you have mediocre credit, let's say 680, 670, but everything else is hitting, you know what I mean? Revenue, the asset is actually worth something. Once they do an appraisal on it, they will lend to you because now in their head, they're like, worst case scenario, if this person defaults, I'm able to take this asset at a steal, resell it, and actually come out in the green at the end. So understand banks are all about risk mitigation. It has to make sense. It has to benefit them in the end. Same thing when it comes to vehicles, everything. The reason why getting approved for auto loans or different things like that are easier than personal loans is because the vehicle is the asset. The vehicle is the asset. If you don't pay, they're coming to get that asset and they're going to resell it for more than they actually gave you for it. Just be honest with you. That's why a lot of people don't understand. That's why banks require down payments, right? Everybody's talking from this legal jargon type of stuff, but let's be realistic from a mindset of underwriting, a mindset of lending, right? They require a down payment because they don't want to take that risk of you getting something zero down. You have no comparables, no history of having an auto loan this high. If you default, they know they can't sell that car at that market price that they gave you. So when they ask you for $20,000 now, it's because they want to stay in the green, right? So in case you do default, they have some type of asset to take away, resell, and still be on the green so they don't lose money. Does that make sense, though? You feeling me?
Bro, you hit it, bro.
100%, 100%. So do you want to go back to the net 30s a little bit more, or you want to move on, brother?
Like, well, what we saying in the chat? Let me check the chat real quick to see. Because I mean, I kind of hit on it. Well, actually, let's just go into it a little bit. I personally, my opinion, and I'm speaking on behalf of Dub Washington. I'm not speaking on behalf of Stedman.Waiters here. Net 30s is a waste of time. You're wasting your time with the net 30s because I line up two profiles, business credit profiles rather. Somebody that's walking in the bank with a whole bunch of net 30 accounts and their payday scores looking all pretty versus someone who comes in there with, let's just be realistic, and have a 55 SBSS score, right? Which is a small business scoring system score. Like, they have a 55, but they have true business credit. They have utilization on a a business line of credit, real utilization on the business line of credit, business credit cards, etc. Like, you're more lend worthy to the bank. And another thing, speaking on utilization, aside from the net 30s, is that most of y'all don't even realize that you are sharing the information whenever you're going through Plaid, you're going through all of these income verification things. These are third-party data processors. So whenever you tell an institution that you make $300,000, $400,000 in a year, but you just connected your Plaid to Bank of America, you connected your Plaid to any of these fintechs, right? You connected it and you let them see the money that's actually coming into this particular account. And most of y'all think that you're getting ahead by adding multiple accounts so you can get a higher limit. Well, what happens whenever they share this data to the other lenders that they may be partnered with, and now you try to go and apply for a $100,000 business line of credit or a $100,000 business credit card, but they see that you have over $100,000 in utilization, on the business side, and then you trying to get another 100,000, but your business only makes, from what they see with real bank account statements, that you only make 50, 60,000 a year, or even 150,000. That's risk mitigation. They're not going to lend that maximum exposure to you because you are already carrying balances, and we see what you actually got coming in. So be very mindful whenever you are connecting all of these different accounts to Plaid, because whenever you're trying to go to fintech and get that $50,000, $75,000 credit card, they are sharing this data. You don't realize it because it's in the fine print at the bottom. You just like, okay, bro, I'm going to go and get this access to this, maximum exposure.
100%. And I actually want to add to that from the alternative lending space. So SBAs, merchant cash advances, business lines of credit, private money, right? So we use something very, very similar to Plaid. It's called Decision Logic. It's called Decision Logic. It's a fintech software. It's like Plaid's competitor, right? On the traditional side, banks use Plaid. On the alternative private money side, we use Decision Logic. Decision Logic will look at your business industry, will log into your bank account, see how much revenue you've had for the past X amount of months, and then give us a base and say, hey, the likelihood of this person defaulting is this based on the industry. Decision Logic does the exact same thing. So he's 100% right. When you're giving these platforms, these third parties, access to your banking information, there's no hiding that. They're able to see every single thing that you have going on when it comes down to that. And that could be a good or a bad thing, right? On the alternative lending space, because it's unsecured capital, we have to do that to make sure that these people are actually making the money they say they are. It can be a good and bad thing, but understand, like he said, when you're connecting your accounts and you have conflicting information, it's a recipe for disaster. You know what I mean?
Yep. Every time, bro. And I tell people, because once again, what you don't know will hurt you the most. So you're thinking that you're getting a leg up by sharing this information to them, when the better way would be to go and just build out your deposit relationship. And that's what we're going to kind of segue to now, is how to actually build out with these institutions to ensure that you get the maximum funding. And deposit relationship is going to be up there compared to nothing else. If you build with an institution, let's just say for 60 or 90 days, and you have consistent deposits coming in, 10K a month, 20K a month, whatever that looks like for you, and there's no right or wrong answer to this, and there's no right amount or wrong amount, is that you are building out with them and they see consistency. So if they want to ask you for docs, guess what? They already got them. So that's why I always tell you, most people are like, bro, I want to go for no doc funding. Well, you can go for no doc funding if you build a deposit relationship, because they won't need any docs from you, because they can see what you got right there in the past of 3 months bank statements, 6 months, etc. So that's one thing that I specialize in, is moving money around. Whenever you go and get access, right, to your first 50,000, 100,000, I would not invest that right away. Other people on the internet may tell you, okay, well, you can get you a real estate property. You can jump into this particular investment. Whatever the case is, 75 to 85% of entrepreneurs never make it past that initial first round of funding due to bad investments. Most people think like, oh, a bad investment can't happen to me. I've done a lot of research. I've done whatever. I understand everything about the industry, and then it goes wrong. Now you up shit's creek, right? So whenever you're going to get access to this capital, I personally recommend that you go out and you have a structure card. You go and get that first 20 or 30K. You just solely going to use this 20 or 30K to just small deposits into other institutions. So now, whenever you get ready to go for funding on a later sequence, you already secured that pretty much.
So my version of that, I'm 50-50 on what Dub is saying, and that's cool. Like I said, we come from two different perspectives, right? So I do understand getting funding and putting it into something that's going to make you money, and that's kind of what I'm all about, right? If you don't understand, don't know what the hell you're doing, and you don't have a plan, I highly recommend doing what Dub is saying and build a relationship and put that money to work, right? But if you do have a concept, if you do have a business and you understand what you're doing, I'm not telling you if you got 50K, put the whole 50K in, but still invest. You still want to make money off of that money, right? Because what I see, and you probably see this too, but this is why my perspective is this, is I see too many people getting access to business credit and just swimming around. They just swimming around. Right? They're just manufacture spending, putting in this account, moving this account, wasting time, right? And time is the most valuable thing we have. I'd rather you put that money into actually, whether it's a mentorship or actual business, to actually get going. Because we got to understand, all this money we playing with is borrowed money. We have to pay it back, right? So I'm not telling you to take the whole pie and put it into something, but there's nothing wrong with chipping away from that pie, getting your feet wet and actually getting going. Because what I see, and I was victim to this when I first started as well, like I talked about with Dub in the beginning, we get into mentorships, we learn about credit, and one of the first things, one of the easiest wins, and put a one in the chat, this is you. One of the easiest wins is manufacturer spending. I'll put a damn one in the chat for that myself, right? I'll put a one in the chat myself, right? Because with manufacturer spending, what a lot of people don't understand, it's an easy win. You go and purchase something, you go to a store, you return it, you get it back on your debit card, and you're like, damn, I just got 5 bands, 10 bands back in my account, and I just earned X amount of reward points that I can go take a free trip with, and it gets addicting. It gets addicting because it's like, it's so easy to do, but you're not actually building the business. You're not actually doing what business credit is part of, right? So it's cool to get out and endeavor in those things and understand, because now you build the skill to liquidate money when you need to for projects, but you still want to keep your eye on the prize and actually build a business that's going to change your life, that's going to change your family's life. And that's why I said I'm against wasting so much time building relationships. Let's get the money and put it into something that's going to make us money. Like I talked about earlier, if you don't have the relationship, but you have the revenue to show, you're still going to get some type of funding. Most people just fall into that boat where they don't have any income, any revenue, and they're just trying to figure out how to get another $100,000, but they already got $100,000 in funding. And we come across that, I would say, on a week's time span, we probably get at least 5 clients a week that fall into that boat. They already got business funding. They already got $60, $70, $100,000 in business credit. They done milk every 0% interest business credit card on the market, and they come to us saying, I need more funding, and they only want it to be 0% interest. And when we look at it, their LLC is a year or 2 old, and we're like, okay, do you have any revenue? Do you have any bank statements? Do you have any tax returns? They don't have nothing. So it's like, what do you do with that capital? And then on the business side, they're maxed out. So I'm like, well, where did the money go? You playing around with money. And that's how people slowly sink, because you start playing around with that money, and that credit card interest start eating up at you, that 0% run out, and that whole year and a half that you had 0% interest, you wasn't actively getting into something, and now you fall into this trap where it's like, damn, I'm paying $1,000, $2,000 in interest plus the minimum, and I'm still working at my 9 to 5, and I only made $3,000 a month. And that's what leads to defaults, and then credit repair. And then you see how the downhill spiral starts in the market. So I am with Dub. If you don't have a game plan when it comes to business, definitely build those relationships out. But if you get access to capital, chip away at some of that capital and put into something and get your feet wet with business. That's the whole purpose of business. It's to be in business and make money. Stop sitting on credit just thinking you're going to save it for a rainy day, or you're going out on trips, you're going out using it for personal endeavors, and you ain't even get started in the business.
Facts.
You know what I mean?
I love it, bro. I love it. 1,000%. Yeah. And I like that you brought that. And that's why we had this call, to give y'all different perspectives. So you can go either route. You see what I'm saying? And another thing that I like to hit on is I'll already be preparing your next 0% funding phase. You know what I'm saying? So whenever you get the capital, like Sted said, you can go and use, if you get 100K, instead of putting a whole 100K and taking it to build relationships, etc. Because I skipped the part on saying that whenever I ran this play, I had a profitable business. I have a coaching business, so I can say, okay, I'll go and get 50K, 100K, and then I still have the income that's coming in, so I can do it. But to the common person, if you don't have that, you need to actually get going with generating income, because like Sted says, that the number one goal of business, despite what anybody think, is to generate revenue. You know what I'm saying? And whenever you are generating revenue, this opens up more banking options to you. And I always ask people this: what does your 0% funding bag look like? Whenever I say, what does your 0% funding bag look like, what are you structuring in the future? Okay, yes, you have a deposit relationship with this bank, but the reason why you're building with them is to get essentially a 0% interest business credit card once you graduate from that personal side. So now I always tell people, have at least 2 or 3 banks in the chamber that you can say, okay, I've been building with you over the past 3 months. So whenever this card runs out of 0% funding, in case the investment has not yielded a return, guess what I can do? I can now come to you and then transfer the balance over, and literally taking the money off of the card, liquidate and manufacture spending, to now transfer a 0% APR phase over to either another card or to another institution. Therefore, you're not paying any interest on this money. So it's very strategic plays that you got to be on top of.
100%. And that really segues us into the most powerful conversation, right? Everybody always gives you the glitz and glamour when it comes to funding and all the things and dreams, and sell you the dreams of what you can do when it comes to it. And a lot of that stuff is 100% real, but people don't give you the realism of it. They don't tell you what not to do with funding, right? And in 2025, we got to start pitching that more, because we see what happens with the 2020, 2021 entrepreneurship run, credit run, what that did and what state that puts us in now, right? We see what the whole consulting as an industry has become in the state of 2025. And that was because of getting access to funding, because banking was way sweeter back then. It was way easier to get the bag, right? Getting that bag, not actually investing into the right things, and now taking the whole industry and now making it really damn near high risk now. You know what I mean?
Yeah.
So where now more banking institutions are now asking for docs for a simple credit card, which is crazy, right?
Mm-hmm.
So
and it's solely, my bad, Sted, not to cut you off, but it's solely based on, you got to think in terms of the bank. You have to think in terms of the underwriter, right? Let's just, and I'm going to paint this picture to you guys, and I hope I don't offend anybody, but what happens whenever you have a particular NAICS code that is, in consulting could be, it's a very broad range of that. But then 2020, 2021, upwards of 2023 came, and then you see an influx of African Americans or minority business owners come in, and then they say they have a consulting business, and then the highest default rate on any NAICS code is consulting. What would you do if you was the bank? You're going to look at the NAICS code of this consulting 541611, and you're going to say, bro, like, based on our non-performing portfolio, we lended out $1 billion. We lended out $150 million. And of that $150 million, about 60 to 70% of it hasn't been paid back because it's currently in default. So you have to be able to adjust with the trends of time, because a lot of y'all have information that was very much valuable back then, but it's no longer applicable in 2025. So you have to stay ahead of the curve whenever you are building this business credit, whenever you are setting up and just putting yourself in position to get access to capital. That's very important.
Somebody in the chat said, what is a good industry to use nowadays? So I used to actually give this out. Sometimes I will when it makes sense, but just hearing us talk and really just listening to myself, I don't even think it's really feasible to give anybody an industry to use. The reason why is
it's a whole bunch of them, man.
It's a whole bunch of them, but also the industry to use should be the industry that you're trying to do business in, realistically. Because when we get on the alternative lending side, when we get on what to do when you have docs, you don't see marketing companies that are actually trucking. You don't see marketing companies that are actually grocery stores. You don't see consulting companies that are actually construction companies, right? They're actually using their next code, categorizing themselves properly, but because they're able to show documentation, revenue, income, they're able to still get the bag, right? So what I don't want to do is just build another wave of, instead of using consulting, use education, use training, and then 3 years down the road, that industry burns out because people don't understand business. They don't understand exactly what they want to do. They just want to get access to credit to then be able to do whatever with it. So one thing I would say is understand what industry, what business you're trying to get into, what you're doing, and choose what makes sense for you to be able to maximize your opportunity. But I'm starting to just listening to myself. It doesn't make sense to say, go make your business education, go make yourself training, because on the, like I said, the more established business owner side, that shit looks crazy when it comes across my desk from my team and it says marketing, but the whole time you got a construction company. Now we confused. We like, what's really going on? You know what I mean? So do you agree with that, Dub?
What, bro? I can't add anything to that, bro, at all. Cause you answered every way I would have answered it. You answered it the same exact way, bro.
100%, 100%. So going back to what not to do with funding, man. We've all been attest to it, and like I said, we didn't come here to sell y'all nothing, so we just giving y'all the real. Man, talk about the beginner phase of credit and the mentorship shopping spree. I'll let you talk about it first, and then I'll talk about mine after that.
Bro, we get we get shiny object syndrome a lot. One thing that you gotta do is check yourself before you get access to capital. And I know it's gonna sound cheesy, but if you don't got the mindset right, you're not going to be successful. It's impossible to be successful without the right mindset, right? And whenever I say this, that's very, very important simply because if you've never touched $100,000 and you get access to $100,000 in funding and you learn the skill set or even learn the skill of manufactured spending, and then you get this $100,000 and you have it liquid sitting right there in front of you and you don't got this right, you will fail in business 100% of the time. And even let's say that you do develop a good mindset. You say, you know what? I'm ready to invest. I'm ready to turn up. I'm ready to, take my personal development or my business to the next level. Now, once you get past level 1, which is that mindset, level 2 is now the shiny object syndrome. You're like, oh, this person got a mentorship. I want to learn from them. This person got a mentorship. The worst advice that we have ever heard in entrepreneurship, instead you can kind of attest to it as well, is that millionaires have 5 streams of income. But they don't tell you that the 5 streams of income come from one stream or one source. So whenever you get access to your first 100,000, that's why I say, like, sometimes, man, you just got to make sure, like, I'm just going to be real. Go ahead and get that nigga out of your system. I'm just going to be real, bro. Go ahead and get it out of your system, but don't do it in a way that is going to harm you. And me and my wife had this conversation. I said, I understand us. I understand the psychology of us. Like, bro, we ain't never had nothing, etc. But you don't want to go and get it out of your system at $1 million versus you getting it out of your system at 100,000, because the habits become worse as you make more money. You have more things accessible to you. So whenever you go and you get your first, let's just say 100K, because a lot of people in the room may not have access to this, or maybe you do. We can even take it higher and say $1 million. You got to have the right mindset, and you can't just fall into, okay, what's working right now, because that may not be your play. You got to understand that.
100%, bro. I agree with everything you said. And just to add on to it, bro, it's like the biggest thing that eliminates, I would say, successful entrepreneurs and non-successful, or just people that get success quicker than others, I'll put it that way, is focus. You got someone that's determined, that know exactly what they want to do, and they want to focus on that industry. The 100K funding they got, they're putting it directly into that industry. They're putting all their time and focus on building that industry and taking over that industry. That's what you want to be. You don't want to be credit card happy, mentorship happy, buying this person course, buying that person course, buying this person course, buying that person course, because we only have one mind, one life, and we only have 24 hours in a day. If you already got a 9 to 5, 8 to 12 of those hours are already out the gate. If you got kids, I don't have any kids, but Doug probably can speak to that. That's probably another 4 hours out the day. Then you got to sleep 6 to 8 hours. How much time realistically do you have to understand, digest, and execute on information if that's your life? Being realistic. And that's what stops a lot of people. You buy this person course, you buy that person course because this person have a success and that person have a success, but you never get started on anything. And like, it goes back to the main goal of entrepreneurship, to make money, right? Don't feel like you're being left out. Your time will come. If you invest into something, make sure you get a return on your investment before going to something else. The only time you should invest into something else is if it's benefiting or helping the cause or the main goal that you have, right? For give you an example, if you're trying to get into the funding space, right? If you want to do credit repair, okay, cool. You can do that to an extent if you want to, because that kind of goes hand in hand. But you don't need to be trying to do trucking, Airbnb, Turo, credit repair, doing crypto. Imagine trying to learn all of those different things. All of them have different learning curves. None of those industries really are the same at all, right? They all have different risk tolerances. They all have different upfront cost expenses to get started. So imagine you trying to start all of those different things and you got $100,000. That $100,000 is going to be gone quick, and you're going to have little to nothing to show for it. So instead of going on mentorship shopping sprees and wanting to buy from this person or that person because they're a good marketer, right? Because that's really what people falling into, is marketing, right? Focus on what you got in front of you. Give yourself time to grow. Too many people want to see instant gratification, and that's not how the world works. You work at your damn job for 20 years and you barely get a raise, but you want to invest into a mentorship and you want to make that shit back tomorrow. You ain't trying to wait. You say, I spent this money, I want it back tomorrow, right? So-and-so made $50,000 in a month. I'm trying to get the $50,000. You ain't even made your first $1,000 in the business, right? You don't understand the sacrifices, the time, the focus, what that person took to make that $50,000. And that's what I think a lot of people get caught up in. Don't let these marketers sell y'all a dream. There's nothing wrong with being an entrepreneur. There's nothing wrong with financial freedom. All of that stuff is attainable. You can do everything you put your mind to, right? but understand that you need to focus on one thing first, figure that out, get a hang of that, scale that out a little bit, and then maneuver to others. When you try to start so many different things at once, you're just, like I said, you're just flooding it. And to give you guys a realistic example, I'm going to always go back to my funding company, right? We get people all the time. We get people all the time that apply, and they tell us one industry or one business they have on the application. My reps call them, and they say, yeah, I do this, I do this, I do this, I do this. In our head, we already know, okay, this person more than likely probably ain't making no money because they just told me they do 5 different businesses, right? They do 5 different businesses, and they're looking for a minimum of $100,000, and their credit score is a 600. You know what I'm saying? So understand that we need to put our focus into one thing, grow that thing, and then when it makes sense to pivot and learn something else, then do that. Or if you're going to take on 2 different skills, 2 different trades, 2 different mentorships, make sure they actually go together. So if you're understanding the lending industry, if you're understanding funding, that can complement a lot of different things because you understand how to get the bag, how to fund people and fund your endeavors, right? But then you can go to Credit Repair to offer that service, right? You can go to maybe a truck and a real estate because you understand you're going to need capital in that business, and you also can offer that funding service to other people. But don't go try to start 5, 6 different things because I'm telling you that learning curve is crazy. And be happy for people. Just because you see somebody winning don't mean you got to have a piece of that pie. Mm-hmm. Just because my guy Dub made $100,000 running the play, it's not your turn to run that play. Stay in your lane. You don't know what Dub went through. You don't know how long Dub been at it. So you can't put yourself in Dub's shoes and say, damn, Dub making $100,000 over here. Let me hop in there, because all you're doing is putting distractions, putting walls in front of your journey, and now it's hard for you to grow and get to where you want to go.
Yeah. And you hit it, bro. And what I always tell people, before you go, and it's kind of like the same concept, before you go on a mentorship shopping spree, spending $2,000 here, and because that shit add up quick, you will look up, right? And next thing you know, you've been spent $20,000, $30,000 with different people, and then they all telling you different information. Now you just running in motion. Like you on a treadmill. You're not going anywhere, but you obtaining information. So what I always tell people is pick one industry similar to what you said, Sted, and master that part. And then you branch away from that. My journey, check this out. My journey started from manufacturer spending. I was teaching manufacturer spending at first, and then it branched into bank auditing, that's what's going to be our next segment that we're going to break down. But everything must be co-aligned with one another. Everything must be aligned up to say, okay, I can take this information from this course or this specific industry and apply it to this one. This how I was able to scale. So I was like, okay, I learned how to liquidate. I learned how to manufacture spend. But my goal was not for the free designer and the free trips and, the free expenses being taken care of. It was more so of, I'm going to put myself in position to be able to get maximum credit card limits. That was my whole intention, but it was icing on the cake to be able to do the free trips and all that extra shit. But my main goal was to say, like, bro, how can I look up in a year and a half or 2 years from me doing this right now and be able to maximize it to the fullest potential? And that was my whole strategy. You know what I'm saying? So do not go on that shopping spree trying to learn from this person, because to be honest with you, majority of the information is still co-aligned with one another. So you'll be paying multiple mentors that's going to give you different viewpoints, and a confused mind will never be successful. You got to get on one track and say, okay, this is the way that I'm going. Similar how I did. I invested into RPX, right? And there was so much different stuff in there, but I seen like, bro, like you can liquidate. And this is what I turned a 7-figure business into. Is it started off with learning how to liquidate, but now it tapped into building multiple banking relationships, bank auditing, and different industries like that.
100%. One question I want to talk about as well that just came up that somebody asked is like, when is a good time to branch off from 1 or 2 businesses to focus on investments or something else? I'll answer that first. So honestly, the most successful people that I know, even like my mentors, 8 figures and different things like that, you never have to branch off into something else if you scale that thing up. Like, people don't understand, like, this might sound crazy and arrogant, but it's not hard to make $1 million in the industry if you put all your focus into it. It's not hard. Like, you can make $1 million in the industry, and it's people that will laugh at $1 million in revenue. Just be honest with you, right? They will laugh at $1 million. Like, okay, cool. You just arrived? Okay, cool. Pull up a chair. You know what I'm saying? But it's not hard to make $1 million in the industry. So honestly, it just depends on if you really need to pivot. You know what I'm saying? Is that really needed? Or can you just create integrations within that industry? Let me give you an example. If you scale a funding company up, and that's one thing I'm doing right now, right? Sales rep to my team so I can replicate myself to be able to do cold outreach, different things like that, run more ads and have more people answering the phone, closing deals. If I'm building this up to a $10 million, $20 million business, I don't need to go start a trucking company. I can integrate within that company. What do I mean in that? I can make my own software. I can make my own funding software that's catered to people in the funding industry that they can use, and I could charge a recurring to use that software. What is that? That's called integrating in the industry. I'm not pivoting away from my industry. I understand the industry. I have value. I have results. I understand what good funders want, what they like in a software, and I can create my own. And then I can market that and give that to the masses. So that's how you integrate. You don't need to actually pivot into something else. Real estate is cool. It's a wonderful thing. There's a lot of other things, right? And if you got money, you want to park it in the real estate. But you don't necessarily have to go from one industry to a totally different industry just to build that up, right? You don't have to be the masters of all. That's what a lot of people don't understand. Like, you can be very successful in one thing and be known for that one thing and never had to do anything else, right?
And I like how you hit on that, Sted. And then I'm kind of segue into this real quick. It's more so about the mindset, because you got to ask yourself, right? Not nobody else. What is your true freedom number, right? Most people think that you need to do $100,000, $150,000 a month, but are you qualified to do that? Are you putting in the work? And let's just say that you are putting in the work. Are you capable of handling the downtrend whenever you go from $100,000 in a month, $50,000 in a month, and then the next 3 months in business, you are depressed because you're only making $5,000, you're only making $10,000, right? And I'm just gonna speak, completely transparent here. Like, I went through that myself because I was having consistent months. I'm talking about we going crazy. Everybody's eating literally, and then all of a sudden you go to a place to where you like, bro, like, I was consistently hitting X amount, and then your family life at home is affected by that. So don't wish for things that you don't know if you can handle, because you go and get 75, 80,000, 100,000 in a month, and you go 2 or 3 months with that, and then you go back to 10,000. You got to be very strong to not let that affect you in your everyday life, because trust me, the psychology behind that is very difficult to handle. I've witnessed it, and you're going to witness that as an entrepreneur. And what most people do whenever that happens is that they try to segue into something else, not understanding that it is seasonality in every single business that you do. And no matter how good you are with marketing, etc., you're going to have ebbs and flows in the business, but how are you able to weather the storm?
100%. I love it, brother. So let's get the auditing on banks, man. That's your forte. So I definitely want you to go crazy on that one, brother.
Yeah, we about to eat with this. So like I asked y'all whenever we kind of first came on, was the bank always pull our credit report. But when was the last time that you pulled a bank's credit report? When was the last time that you look at the bank's deposit ratio? When was the last time that you look at their non-performing loans? What are they overexposed in? And whenever you look at the credit unions and the community banks, are they over leveraging the commercial real estate sector? Basel III endgame, right, is coming up, and they're saying that they're going to extend it. And once again, I'm going to be honest with y'all right here. I know that the people in the chat saying Basel III endgame, like, what is that, Dub? I'm going to give you homework to go and do that, because I literally seen our people go and dissect everything in Kendrick Lamar's halftime performance and say, oh, that's the meaning of this. And, oh, did you see the PlayStation control? If y'all got time to do that, I'm not going to give you the answer to this test. I'm telling you to go through and look up Basel III endgame, because it's going to affect each and every one of us. So whenever you're going to audit the bank, you need to understand, okay, where is the lending climate headed to? Stop walking into banks asking for products that they don't specialize in. You know what I'm saying? And it's a few questions that I want you to always ask the banker. And if they can't answer the banker, and if the banker can't answer these questions, they may not be the banker for you. So the first question that you want to always ask is what bureau that you pull from. This is just a basic, simple audit for you. What bureau do you pull from? Not only what bureau do you pull from, do you use that same exact bureau for all of your products? Because you can go and apply for a business credit card at PNC, and they're going to pull your Experian. But then whenever you apply for a business line of credit, it's a soft pull on your Equifax. So you got to know whenever you're applying for multiple products, what bureau do you use, and do you use the same as that bureau across all products? Of course, you want to understand the requirements. How old does the business have to be? Does it have to be 1 year in business? Is it 2 year in business? What type of documents do you require? If you have multiple businesses, do you offer multi-entity funding? Synovus is a bank that will offer you multi-entity funding. They pull from Equifax. If you have 3 businesses, you can literally walk into Synovus, of course, build out a relationship with them, and then from there, you can go and get funded under each one of your businesses. So now, as we talked about previously with the business utilization and being denied for business credit cards for that, you can spread out some of that business utilization across multiple entities. You know what I'm saying? So I'm going to stop right there, and I'm going to let my brother kind of dig in because I see you ready to cook, bro.
Yeah, man. And like I said, that's the value of what we bring, just 2 different perspectives, man. So he's letting y'all know how to build that relationship, how to go about when it comes to lending, to be able to fly by when it comes to no docs, right? We both agree that, hey, the goal of business is to make money. And when you start making that money, that's when you cover on my side, because that's where you're able to get that real hardworking capital that you can put to work. But you need to start, right? You have to crawl before you walk. You have to walk before you run, right? I'm on the walk and run phase when it comes down to it. But my guy Dub is going to get you right when introducing you to the bank, dating the bank, understanding their rules, what they like, what they don't like, and how you can fit in it all, right? All of this is experience. What you guys that have stayed here the whole time, what you got in is 10 years of experience. What you got is 5 years of experience. The bad, the good, the ugly, right? And that's what we're going to do. So, yeah, man, we're going to segue into the alternative lending space, right? We're going to segue into once you have a proof of concept in your business, you understand funding, you did your credit card stacking, you have a business, you have employees, or you just generate revenue. I'll just keep it simple. You generate revenue and you're saying, yo, Sted, like, I don't want any more credit cards, right? I want to take this shit to the next level. I want to be able to go get another brick and mortar. I need working expansion capital, right? I need business acquisition capital, right? I may have a low credit score, but my business cash flows, and I need an answer on how I can still get the bag. And that's kind of what I'm going to break down when it comes to this, right? So for you guys that don't know, like I said, I'm heavily in the alternative lending space. It's a different type of space. And the funny and weird thing at the same time about this space is the traditional lending space and the alternative lending space usually doesn't talk, right? Most people that I talk to that I know that are in the alternative lending space, they don't even care about the traditional banking space. It's like a totally different language. They're like, oh, the merchant or the client, they can do it themselves. That's baby stuff, right? And then the people on the traditional side, they don't understand alternative lending. They look at it. 1, most people on the traditional side don't have docs, so they're automatically eliminated. 2, you know what I'm saying? They don't have any revenue, and that's kind of what the alternative lending space is about. It's typically for more established business owners that already have a proof of concept. They're already making money in their business, and because you have that revenue, a lot of these lenders will overlook the credit standpoint, just to be honest with you guys, if it makes sense. So we both can agree that a 650 credit score is mediocre in traditional. You're probably not going to get much funding with a 650 credit score. Am I right, Dub?
Yep, for sure.
Gotcha.
You're not going to get it. And kind of to segue, not even segue, but kind of just elaborate a little bit deeper on what you were saying is that a 650 credit score typically has common factors associated with it. You know what I'm saying? So you may have some late payments. You may have 40 to 50% utilization. You may have 1 or 2 collections on there. So whenever we hear it, and that's the experience that we have in the space, is that whenever we hear a 650, we can kind of pretty much gauge what's going on with your profile, right? Similar to like a 720. Yes, that's a good score, but a 720 typically tells us like you got just a little bit of utilization on your profile. So 1,000% everything that you're saying, bro.
100%. So he just broke it down from the traditional aspect. On the alternative lending side, that's pretty decent. That's pretty decent. Why? Because they want to see that decent, mediocre credit score combined with revenue. And if the revenue is there, they'll have a section on the credit score itself to get you that funding, right? So when I kind of speak about alternative lending, it's multiple different aspects when it comes to alternative lending. It's not just one product, right? So I just say alternative lending because I don't want to say all the products at once, but I'll go ahead and let you guys know what I'm talking about when I speak on alternative lending. It's a SBA. If you guys don't know what an SBA is, it's basically a government-backed business loan, right? You got to be in business for at least 2 years to actually qualify for that and have personal and business tax returns, right? Then we talk about equipment financing. Equipment financing, you want to have a little bit better credit. The equipment itself is the asset, and they do like to see some comparables, but they're kind of leaning on the credit side as well. You have merchant cash advances, which is basically the purchase of future receivables, right? So a merchant cash advances, they will look at your cash flow and they will say, hey, for the past X amount of months, you've been generating 20, 30,000. That's collectible. We can give you this amount, right? And then we're going to talk about true business lines of credit and some business term loans and bring it back in, right? So all of these different products have different type of avenues and different ways you can qualify for it. So the biggest thing that I see people always want in the space is the SBA. So I'll kind of break that down first, right? Like I talked about, there's multiple different products in the SBA. You have the SBA Streamline or Express. That's where you can get up to 150,000. Usually it takes about 10 to 15 business days to close. That's probably the lowest amount of docs that you will be requested from when it comes to that type of loan, right? Typically, they want 6 months of business bank statements, a signed business application, driver's license, and usually 1 year personal tax returns and 2 years of business tax returns. To just justify that, it's very clean and quick if you meet those data points, right? When it comes to tax returns, it's not just meaning you file your taxes, it's making sure that you're showing a profit on your taxes. So a lot of us, we get into this mindset of like, we can do all these different things and write off everything and say we took a loss and not had to pay the government anything. But understand, depending on where we're at and we're in our business and what we want to do the next year, we actually do want to show profit. That's both on the traditional and the alternative side, right? If you've been in business for 5 years and every year you say you took a loss, not only is the IRS gonna come knocking at your door, but it's also gonna be very tough for you to be able to get access to funding because they're gonna ask for tax returns. And if they see every year you've been taking a loss, you're not a profitable business. Nobody wants to lend to you, right? So understand those things are very, very important, and we need to start playing chess and not checkers when it comes to that. But if you have no previous defaulted loans when it comes to student loans, FHA, anything government backed, you probably can qualify when it comes to an SBA loan, and that's kind of where we come in to help you. Another one that you have is your SBA microloan. Is anybody familiar with the CDFIs? Anybody familiar with CDFIs? Put a 1 in the chat, right? So CDFIs are usually your community lenders, right? Where you can go and get funding from. They usually serve more so underserved communities for minorities specifically, right? So your CDFIs are usually the ones that handle the SBA microloans where you can get up to $50,000. There's not much documentation needed with that, and that's a quick turnaround as well. If you're somebody that wants that big guy, that's where the 7A comes in. A lot of people talk about the 7A. They see that 500,000, they see that 800,000, they see that lend up to 5 million, but it's a lot that goes into play when you're dealing with those type of files, right? It's very paperwork intensive, and you got to have your ducks in a row. A lot of 7A files get killed in underwriting because stuff doesn't add up. I'm going through one file right now for 500,000. One lender declined, the other lender gave them a partial approval, but they want a reason why. Hey, why in 2023 you had a significant decline in your revenue? Like simple stuff like that. They want an explanation because they want everything to line up because it's an application for 500,000. Understand, when you're looking for 500,000, it's a whole total conversation than 100,000 or 50,000. So you got to have your ducks in a row. The best way, even if you're not there yet, to prep yourself to be able to get access to these products is by one, getting started with business. Getting started with business. Every person that comes to our business that we're getting SBAs or doing different products for is simply because they started where we're at today and actually getting their hands dirty and actually getting in business and making money. And things will fall into place for you guys that are looking to get there. We also have the SBA 504. That's usually when real estate is attached. And that actually really helps depending on what type of file you got. That's a little bit more intrusive, so we're not going to go over that one. But SBAs is out there, is one of the best products you can have, but you got to have your ducks in a row when it comes to that, right? So here's the most common product that I see business owners that have a cash flowing business but may not have the credit score, right, for traditional banks that we see them get, right? It's usually merchant cash advances and business lines of credit, right? I'm going to go over merchant cash advances because before I got into this space, I probably had the same mindset as a lot of you guys on the call. Oh, they're high interest products. They're trying to ruin people's businesses. They're not this and not that. They're trying to take over people's businesses. That is 100% not true. That is 100% not true. And when you actually get into this space, you start to understand the product and how it works. So a merchant cash advance is not even a loan, and it's not even an interest rate. So when you try to use an interest rate calculator, there's no interest on that. You start to see these sharky rates. because merchant cash advances, they want daily or weekly and rarely monthly. If they have a daily or weekly payment, because that payment turnover is so rapid compared to a general monthly repayment plan, the interest rates look higher than what it actually is. That's why merchant cash advances do not have interest rates, right? They have a factor rate and a buy rate. I just want to make that clear, right? So let me break that down, who this product is for. A merchant cash advance is not for every type of business owner. A merchant cash advance is fit for two type of avatars when it comes to business. One, if you have a low credit score, but you have a cash flowing business, a merchant cash advance can help you save your business and build your business. Why is that? We both can attest, me and Dub, right, agreed that traditional banks have a credit box. They don't give a damn how much money you make, because at Chase, you thinking because you bring in $100K in deposits, you doing something. There's somebody at Chase Banks that's depositing $1 million a month. So your $100,000 ain't nothing, right? The BRMs that we talk about, when they tell you, oh, I usually deal with clients that are doing anywhere between $5 to $10 million in revenue, those are the big fish. And there's even bigger fish than that those private Chase bankers work with, right? So understand that your $100K, your $50K a month is good. Don't get me wrong. I don't want to belittle it. But at these traditional banks, there are things that, like I said, they're more emphasized when it comes to with that type of stuff. Excuse me, guys. Let me go ahead and do that. I was rolling. Had to put my phone on D&D. So going back to it, these traditional banks have a credit box. When it comes to alternative lending, these private money lenders, they're there to help you when you can't meet that credit box. Let me give you an example. If you have a mom and pop pizza shop and you have a 550 credit score, you cannot go to Chase. You cannot go to Wells Fargo, right? But you can go to these private money lenders and get capital right away. Yes, this capital is going to be a little bit more expensive. The reason why is because you're risky. It's a reason why Chase, why Wells Fargo want to approve you. Your credit score shows them everything they need to see. So if somebody's giving you a second chance, being able to take this capital, reinvest into your business, you need to understand where you're at as a business owner, right? Looking at your profile, like Dub talked about earlier, where are you at? If you're in the 500, 600, 400, even mid 600 range, you technically don't qualify for traditional lending. So you can't have your cake and eat it. This ain't the time to be bougie. This is the time to say, okay, can I put this capital to work? Does it make sense for my business? Right? Does it make sense for my business? Can I take this $20,000, even though it's a daily payment of $150? Can I take this $20,000 and put this money to work and make money off of it? And we got to have that conversation and be realistic from that standpoint, right? And to understand when it comes to merchant cash advances, it's a reason they ask for bank statements. It's a reason why they want to see cash flow, because they want to work with you. They're not here to drown you in debt. They're not here to drown you. They base lending off of what you can handle. So when they look at your bank statements, they look at your cash flow, they know already what kind of daily, what kind of weekly, what kind of monthly payment you can handle that makes sense. And because you're riskier, they may want a daily payment to secure, right? As entrepreneurs, we got to understand, we savvy. We get to thinking, right? If we got a month to pay something, we're going to put it all in. And sometimes those risks don't work out. But then when the lender calling for their money, you know what I'm saying? You ain't got nothing for them. And they asked out. So understand, when they ask for daily or micro payments is what they refer to them as, it's because they want to make sure that that money that they're giving you, they're actually getting that back in a timely manner. And you're not able to stretch that out to go try to invest in this and invest in that and somehow lose the money that you're supposed to be paying them back. Right? So merchant cash advances can help a lot of people out of here. And I see a lot of people talk shit about them, but they don't understand how the product works and how you can use it. Like I said, there's two people that usually use merchant cash advances. It's people that have no other alternative, meaning they can't go to a traditional bank because their credit score sucks, but they have revenue, or people that actually know how to use MCAs, right? We have a client that we funded multiple different times. He works for basically a business acquisition company. He understands MCAs and how he can use it. If his business acquisition company cannot buy a business, he will get an MCA to buy that company, tweak it up a little bit, get it right to the parameters to where his company would then buy that company. He gets paid out. He pays the MCA lender back out, and now he's making money in between. Those are people that know how to use money and use it the right way. So when you look at capital, understand your situation, what you really can qualify for, and make sure this makes sense. So if you can actually use this capital, right? Same thing with a business line of credit. With business lines of credit, everybody typically want business lines of credit. On the alternative lending side, if you have a 650 with decent revenue, I'll say about 15, 20K a month, we can get you a true business line of credit. The same thing when it comes to that. Some of them want weekly payments depending on your file, but it just depends on what's coming through, right? So understand, once you get out of that box of no credit, no doc funding, Even if your credit isn't the best, you can move over to the alternative lending space. There's products that are meant for people with good credit. There's products that are meant for people with bad credit. But understanding your situation and how you can navigate through is how you get going. And the beauty about MCAs, I'm going to go back to it, that a lot of people don't realize it, they're relationship based. They're relationship based. Me and Dub can start an MCA fund right now and fund money and lend out money, right? Because it's private money lenders. Understand that you're not talking to a bank that's an underwriter that's employed by a bank and they don't care about your emotions. If you tell one of these lenders, hey, I'm having a slow month, can we adjust payments? They will do it. Ain't too many banks doing that. They will do it to work with you because they want your business and they want your business to survive. Understand they make money when you make money. So when you look down on MCA companies and different things like that, understand that they're there for you and they're there to work with you. Obviously, they have to make money, but they're there to help you build your business up when it comes down to it. And then when you renew, let's say that term is up, you get a 6-8 month term. When it's time to renew, you got skin in the game with them. They're willing to give you a better rate, right? Now monthly can be in conversation because you did good on that existing term. They done business with you. They know how you flow. They see your cash flow. Now we can have that conversation of, hey, can we move the monthly payments? Can I get a better rate? And that conversation can happen. But understand that the goal with business is to make money. So understand those things. I'm good, brother. I done went through, last thing, equipment finance. I didn't go over this, right? So last thing, equipment financing. The beauty about equipment financing is it allows you to free up your cash flow and not invest into basically equipment, right? So let me give you an example. I'll give you 2 examples in one program that's very, very cool that I love, right? It's basically the buyback program when it comes to equipment financing. So if you have a restaurant and you purchase a grill, right? Did you know that if you purchase that grill within, let's say, within 60 days, an equipment financing company will actually, it's called a lease buyback. They will buy that grill from you and put you on a monthly term to pay that. So if you pay $60,000 for a grill and you want that $60,000 back to free up cash flow in your business, you can do what's called a lease buyback. That equipment financing company will actually buy that equipment for you and put you on a weekly or monthly installment plan to pay off that equipment. Now you free up cash flow in your business. Now that money can go more towards payroll, marketing, different things like that. And that's how we grow the business, right? We don't have to kick out all of our money to get started when it comes to funding, right? The same thing when it just comes to general equipment. Instead of you putting your money out, if you haven't purchased it yet, why not do equipment financing? There's so many good programs when it comes to that, to where you can get somebody to actually purchase the equipment for you, or you can lease the equipment. You can lease to own. I know we hear that a lot in real estate when it comes to homeowners, right? Or property owners, whatever you want to call it, but it's also like that in the business alternative lending finance space as well. You can lease to own equipment. So if you start out leasing laptops, if you start out leasing a kitchen, a stove, whatever the case may be, you could potentially work your way up. Once that term is over, they give you the option to buy that equipment outright. Now, if you are starting a company and you have 8 employees, you don't have to worry about kicking out $20 equipment, right? You can go ahead and have that lease, have that equipment there, be on a monthly payment plan, and as you generate revenue, you're paying off the equipment, and at the end of that term, you have the opportunity to purchase that equipment outright, and now it makes sense. We're all leveraging debt. Understand there's different ways to leverage debt. You can go to the bank, get the bag, and invest that money, or you can go to the private money side, the alternative lending side. What makes sense sometimes for you guys to do, to be able to get equipment finance, to be able to get a merchant cash advance, to be able to get an SBA, to get the job done. So one thing I want to say with that is, a million ways to skin a cat. It's a million ways to skin a cat, right? It's not just one way. You don't just have to go to Chase. You don't just have to go to Wells Fargo. If you have revenue in your business, you can leverage that revenue to get access to capital, no matter if you have great credit or challenge credit. It just has to make sense for everyone. So that's one thing I wanted to say, brother. This has been great, bro. This has been amazing.
Yeah, bro, you see I let you cook. You know what I'm saying? Sometimes when people get in that element, you got to know that you got to sit back and set the screens and be like, all right, bro, I got you. I'm going to set these screens. I'm going to keep feeding you the ball, because majority of the people are going to fall in that particular category to have to get alternative lending. Everybody won't have, with the traditional funding and kind of like what we both do. But, that's more so my specialty, is that most people are not going to qualify for these large lines due to several factors. You don't have a 750 plus. You don't have the revenue. So that's why whenever, I was like, bro, like, we got to give some game to the people to let them know there are other alternative lenders out there, to where you don't have to have these high ass credit scores. Because let's just be truthful. You got to actually go in, and I'm a big research person, but what about comparing yourself to the average credit score by your state? You know what I'm saying? So Like, I'll see that most people will do the alternative lending. So guess what? I recommend y'all do the same exact thing. If you know an institution or there's a state that have less than credit scores, guess what? I'm gonna go there and I'm gonna try to get some funding from them, because the field in which you're playing against, you're able to leverage that to get more capital. So everything that he said was spot on. And another thing that I want to add is, whenever you are going to get funding, make sure that you understand these max exposures, right? Not only the max exposure across all products, but max exposure for that particular industry and max exposure for that underwriter. Like, once again, I told you earlier, you're building multiple relationships with the same exact bank. You just think it's different because the name is different. The underwriter is the same, and the underwriter is the actual bank that you're building with. So whenever you're going out and you're building these relationships, be very strategic. That's why I tell you, audit the bank, understand where they lend at. Most importantly, understand who the underwriter is, because that's going to tell you everything. You know what I'm saying? So, like, bro, this was definitely one of the ones. For sure,
man.
I like this.
Look, we gave y'all everything, no glitz and glam. We didn't give y'all a call to action to buy anything, nothing like that. We just gave y'all our cold hard evidence experience, what we done and how you guys can get the bag, whether it's through, traditional avenues, through alternative avenues. And let's be real, even on the alternative side, because somebody asked about like interest rates and stuff like that. How many of y'all realistically, if you got a business and making money and need more money, finna sit down for credit repair? Right? I used to do credit repair. So I'm just being honest. How many of y'all realistically sit down waiting 6 to 12 months if you can get access to capital now to invest in your business, right? So that's a conversation that you got to have as well. And all of us in here are financially literate, understand credit, but most of America doesn't. That's why credit is not really talked about. This information not talked about in school. They don't tell you how to structure your credit. If that was the case, everybody would be getting $100K in funding. But that's not the case. People don't know how to do it, right? So that's where we come into play. So yeah, man, this was amazing, bro. This was amazing.
This part one, like, y'all don't even know like what we got in the chamber. So this, just imagine, man, like, this is part one. And the thing about it is that we're not all over the place with it. We are specifically focused on funding, because we know right now that is the number one thing that entrepreneurs and business owners need. You don't want to come to a place to where people gonna give you the game, but then they got a call to action behind it. They want to sell you something. Y'all know I say everybody eats. Sted came and bless y'all tonight. I came and bless you tonight. If you're waiting for a call to action, we don't have it for you. We wanted to solely come and bless you with information, because once you go and leverage the information that you do got access to, you go and get you some funding. Guess what? You're now gonna come back and say, listen, bro, like that live stream that y'all did was so impactful. How can we work together even more? And that's the main goal here.
100%. Let me ask, bro, you want to take a few questions, or you done for?
I'm gonna let you call it, bro. Like, I can talk this shit all night. So if you want to take maybe like 1 or 2 questions, I'm cool with it.
Yeah, we could take 1 or 2 questions. I honestly don't know how to unmute y'all, or if y'all even can unmute. So put some questions in the chat, I guess, and we'll answer it that way. I don't know if I can unmute. You know if they can unmute, Dub?
I don't think they can. I don't think they got the we didn't set it up to where they can unmute.
Got you. So if you got some questions, put it in the chat, and we'll kind of go over it. So somebody, JC, you've been asking this damn question since the beginning of the thing. How do you send the client accounts to collection and sue if they don't pay? So that's going to be all on if your contract. Honestly, do you have a legible contract? Is your contract actually in play? Was it drafted by an attorney? Did you collect the proper documents? How did your contracts fit, right? Collecting the proper documents is the biggest thing. I'll pause for a second because I want to like kind of break this down in a 3rd grade level. Collecting the documents is the biggest thing, because what do banks do before they give you any funding? They get your license, Social Security, all that good stuff. To be able to even get somebody to a debt collection company, you have to have that in play, because they're going to ask for their personal information to put them on a debt collection account and put that collection on their account. So I want to ask, do you have those things in play before you even go forward with anything? With that, you know what I'm saying? Those are the things that you want to have in play. We got to stop doing handshake business when it comes to funding in 2025, right? Before you do any business with anybody, you provide any service to anybody on the traditional funding side, you need to make sure you have an actual contract, right? If you don't have one, have an attorney local to you draft one so that it's actually legally binding. You do not need to send it through email. You need to use a platform like DocuSign, Go High Level, PandaDoc, something that actually saves the IP address, different things like that. If you have consultation calls with these people, whether it's through Zoom or a phone call, make sure these things are recorded as well, because that's all documentation that can help implement what you're trying to get done, right? And then before you even fund anybody, you need to make sure you collect the proper documents, right? You need to get their license. You need to get the social security number. You need to get all their personal information on top of their business information. One, it helps you to fund them. Two, it alleviates people running off on you. What I mean by that, if somebody has intentions to run off on you, they're not going to do it. More than likely, they're not going to do it if you have all that information. Just being transparent. Like, if I'm giving you my social, my license, you know where I live, you know where I stay, all these different things, I signed a legally binding contract, I told you several times yes, then you're not going to get ran off on. Another thing you can do as well is get a routing and account number on file or a card on file. However you want to do it. That's one thing that we do in our company as well. And you can do a small little deposit to see if it's actually active, right? And have in your contract that, hey, if X amount is not paid within 5 days after receiving funds, or however you want to pivot that, we will auto draft that from your account. And when they put that account and routing number down, make sure you actually verify that so that you can pull from that, right? So you can have all these parameters in play to make sure you're dealing with stand-up people. A lot of times it depends on the people that you're targeting, right? So everybody promotes funding, everybody wants funding, but everybody doesn't, I'm not going to say deserve, but everybody shouldn't get funding, right? These people that want funding, that have no plan, they just want to have credit, don't fund those people, because those are going to be the ones that you're going to have to run after and do all this crazy stuff with when it comes down to it, right? And then from there, there's multiple different debt collection companies you can use to actually pursue that. I'm just a quick Google search, you know what I'm saying? But make sure you have those parameters in play, because I can tell you a debt collection company right now, but if you don't have those parameters in play, that shit going to get thrown out, right? Because if anybody's in here that's in credit repair, when we send a debt validation, we're asking for all these things. And if you don't have all those things, that shit getting taken off your credit report right then and there. You know what I mean? Got you. So that was one right there, Dub. I'll let you wrap on the next one if you want to.
Let me see. So that's pretty much credit buildings. Let's see. So what's a good, strong personal credit profile for funding? We broke that down like at the beginning of the call. Just basically diversifying the revolving installment, having large lines, and more so the banking relationship that you build. You know what I'm saying? Like, you could alleviate a lot of the requirements for a bank if you just have a deposit relationship with them. And that's kind of like what I speak on heavy, is like building out the relationship with the banks before you actually need the funding. A lot of people skip over that. It's like, okay, what does my profile need to look like? Well, it really don't matter what the profile look like if you have 1 year relationship with the bank with consistent deposits. You know what I'm saying? Or, having multiple products with this institution. You got a personal loan with this institution that's paid off. You got a auto loan. You got, personal credit cards, even a business credit card. So a multitude of factors will go into getting funding from a particular institution. But even a step further than that is, how have you built that with the underwriter? Eline Financial underwrites for a lot of institutions. So does TCM Bank. So does ICBA, right? And I know Sted, he spoke on the alternative lending, but probably in a lot of those alternative lenders like ICBA, which is the Independent Community Banks of America, they may do a lot of their underwriting. So you say, you know what? Let me build out my underwriter internal score. You see what I'm saying? Discover and Capital One just recently, it's not official yet, but they are about to merge together. So now you got to think, whenever Capital One takes over Discover's portfolio, if you got negative remarks or you ran off on Discover, like, that's going to affect you. If you ran off on SunTrust and BB&T back in the day, they have now formed to create Truist. So you got to make sure that you are building out internally with these institutions. And even a step further from building out internally is knowing who the underwriter is, so you know where you stand at within these institutions. So yeah, bro, this was good, bro. We cooked for like 2 hours, bro.
Hell yeah. I'm going to answer one more, and you can answer one more as well. We'll wrap it up, guys. Can you guys speak on the virtual office situation, Regis Opus, or something else? So one thing you want to use when it comes to virtual office is use the USPS lookup tool, right? So just look up on Google USPS lookup tool. You can actually use that, put in the virtual address that you're considering using, and it should show you if it's a commercial mail receiving agency or not, right? So when you put that virtual address into the USPS lookup tool, some virtual offices, they let you know right away that they're a commercial mail receiving agency. If it says yes, then don't use that one. What people don't understand is that a lot of these banks on their applications, they're synced directly with the post office, right? So any information that the post office has on the address, the bank actually has as well. That's why when you're filling out opening an account or filling out an application, they kind of auto-populate and they can tell you already what's going on. So one hack that we use with our clients, or just free game with you, is use the USPS address lookup tool to kind of see what's considered a commercial mail receiving agency and what's not. Regis and Opus, I generally said don't use those typically because those are the most known. Those are the most famous. Like, you got to understand in business and really anything you do, when everybody goes right, sometimes you want to go left. You don't want to follow the crowd because when everybody doing the same thing, now it's like you just falling in line with them and they getting the same result and they default and everything else. So sometimes you want to go left and do something a little bit different. So Spread said don't use Regis and Opus, but to be more in tune and detailed on what I talked about, just use the USPS address lookup tool, look it up, whatever virtual address you're consider using, type that address in, it'll let you know right away if it's considered a commercial mail receiving agency or not.
Got you. And then I'm going to close it out with this one. Somebody asked if they should open up a credit repair or funding business first or any variation of it. I would say do what you got the most clients in, right? If you got more clients for credit repair, you could graduate them from credit repair to funding. If you are majority of funding business, you can partner with another credit repair company to say, hey, let's work out a partnership to where you get to people credit reports, up to date, et cetera, up to par. Then we could partner and then, you could make money that way. So instead of before I would start a new business, I would partner with other people to see what's actually working right now. And then I would dictate it from there.
100%, 100%. Man, if y'all enjoyed this, man, put on your story, tag me and Dub right now.
For sure, man. Definitely do that.
Said, follow me and my guy Dub. We ain't coming to sell you anything. We just added value to you guys. Put us on your story. We're going to repost it. And we're going to ask you guys about part 2. If y'all mess with that part 2 and y'all want us to do a little funding workshop where we bring some dummy credit profiles and we dissect from A to Z how we would fund those, what's going through our minds, and you get to see 2 different avatars, 2 different mindset, 2 different perspectives, let us know, man. Let us know, and we'll go ahead and do that and get it done. Get it done.
Yes, sir. I love it, bro. So listen, man, you came here, you got some good game. And the number one thing that I can pretty sure that, Sted would agree on it was execute on this information. And I tell people this all the time. Yes, we do have funding businesses, but don't wait on us to fund y'all. You got the information now on how to go and fund yourself. You see what I'm saying? So, man, dive deep into this information, research it, study it, because like I say, man, the level of your exposure is going to determine your level of success. So, man, stay at it, keep grinding, and I look to see a whole bunch of 7-figure earners in here, bro.
Get active in the space. Don't overthink. Execute like my guy said, and we look forward to seeing y'all.
Let's get it. Let's get it.
All right, peace. Dress the part. I knew when we came on, bro, it was about business, so I had